You talk about this net sales improvement, up 34%, improvement everywhere, every business, every region, but overcoming all these challenges. Talk to us about supply chain, inflation, how you managed to overcome it.
Thank you, Caroline. Great to be with you. And we finished very strong in a pretty tough year. I'd say on top of COVID-related supply chain and logistics challenges, we had obviously a freeze last year down in Texas, which we had to recover from, and some hurricane activity. But the team did a good job and kept things in focus. As we look forward, December was a pretty good month for exports. It was our best month since March, which shows a little bit of improvement in marine-packed cargo shipments, which has been in the focus, obviously, the last half of last year. And that's probably our biggest supply chain and logistics challenge right now. And as we move through the year, I think that will improve. It's labor related. Obviously, it takes a lot of people to run a logistics operation, and hats off to all of our own people and suppliers who've been helping us get that done. But the demand is good. When you look downstream, demand for food, packaging, personal care items continues to be strong. Housing, as we saw, December housing numbers in the U.S., quite strong. That also has a knock-on effect towards durable goods, appliances, electronics. And then we haven't yet seen the full impact of infrastructure and industrial spending, which I think will ramp up through the year. Infrastructure in areas like 5G, which was part of the infrastructure plan here, but also roads, bridges, and continued improvement in the automotive sector as they get past the chip shortages. Yeah. And I think we'll see that materialize in the back half of the year.
Talk to us about that. I mean, interesting. Yesterday we heard from Tesla talking about the supply chain headaches they still weather. We heard from Intel still seeing a chip crisis out until 2024. Even Fed Chair Powell talking about the chip crisis until 2023. For you, are supply chain issues going to ease by this year, or is it going to take another couple?
We're starting to see improvements. We were a little bit limited in the fourth quarter. That freeze took so much out of inventories and took a lot of resiliency out of the supply chain, and then a hurricane at the end, as well as supply chain challenges. But our operating rates are very good right now, and some of the things are improving month by month, week by week. So I think as we get through the first half of the year, we'll see our petrochemical supply chain improve. The chip shortage is hurting some downstream manufacturing, whether it's in automotive or instruments and controls and other areas. But I think the projections for light vehicle production are still pretty good for this year, about 85 million units around the world, which will be growth. And I think our view is that it'll probably be skewed to the back half of the year versus the front half of the year. There's clearly the consumer is strong. They've got a great balance sheet, $5 trillion of spending power built up, and I think that's the strongest we've seen in a while, even with the great consumer spending. But if inflation takes some out of that, I think you're going to see infrastructure and industry spending make up the slack. And a little bit of inflation is not bad in our sector. Typically, we outperform in an inflationary environment.
How have you done so far, Jim, with regards to pricing power, if at all?
Well, pricing has been strong on two fronts. One, just supply-demand balances have been so tight. And secondly, oil price has been very constructive. My sense as we move forward is oil price is going to be in the $75 to $90 range this year, mainly because the amount of spare capacity for oil is quite small, a couple million barrels per day. And demand has been stronger than everybody's anticipated. And so that's what's been positive in driving that construction. On the other hand, LNG prices, as we saw, spiked in Europe in the fourth quarter, are still very strong right now. That's driving a lot of production of natural gas. Natural gas is going to be a very strong fuel, and as that grows, that really helps our competitive advantage here. I think natural gas prices after winter will come off in the U.S., and that oil to gas spread helps our business. So that for us is constructive. I think you see that obviously at the gas pump when you go to buy gasoline. You're seeing the impact of that as well.
fold in the great balance sheet analysis that you guys have at you and your company with some of the other broader market sentiment that we're feeling really in the last 2 weeks. We noticed, of course, in the quarterly press release, you're talking about returns to shareholders, about $500 million in dividends, $400 million or so in share repurchases, with the stock off, and a lot of the broader market is as well, 12, 13% from some of the recent highs. How are you thinking about the more attractiveness of these share repurchases going forward?
That's a great question. We deliberately worked hard on the balance sheet. One of our goals was to come through the pandemic with the strongest balance sheet that we could have. And we're at that point right now, which is great because we want to move into organic investments to drive our sustainability and also to decarbonize our assets and grow our footprint. At the same time, it takes time to ramp up that CapEx spending. So in the near term, where do you deploy that cash? Last year, we made some conscious debt reductions. We made a contribution to our pension liabilities, and as interest rates grow up, those pensions will become fully funded. So now we're going to have some cash tailwinds this year. We're going to have about $1 billion coming because we made the pension contribution last year.
Yeah.
We have a high yield on the dividend, and we want to continue the pace on the share repurchases. And that'll be a nice return to our shareholders.
Thinking the investor, thinking the employee, but I'm thinking of your global perspective right now, Jim, because we have the IMF, the World Bank cutting their global growth forecast. We've got, of course, the U.S. investor that's trying to digest how far and how fast the Federal Reserve will go and how that could dampen future growth. Are you confident that we can sustain a good clip of growth in 2022, 2023, as you talk about a strong consumer?
We're looking at 4% GDP growth, U.S., Canada, 4 to 4.5% globally, which kind of relies on a 5 to 6% number coming out of China. And I think we'll see the really first signs of the Chinese year as we come out of Chinese New Year, which is early February. It's been a little bit slow at the beginning of the year, but that's not unusual in this time of the year. But I feel like that's a good number. At those rates, we grow at about 1.5 times GDP. We think with better reliability, less headwinds that we had last year, we could see 6% volume growth moving forward. So even though prices will come off some and have really moderated a little bit, I think the volume growth is still there. And those higher operating rates fall right to the bottom line for us. So I feel good about the outlook. We always have to keep a watch on anything that destroys demand. But so far, I haven't seen anything that's destroying demand. The order book is still strong.